Hi, I'm Michael Yardney, and I was interested to read that in the past year, Australia added about 38,000 new millionaires to its population of high net worth individuals. That's about 100 new millionaires each day, many of them on the back of their property holdings. However, at the same time, a large number of property investors haven't achieved the success they wanted. Now, of course, this isn't really surprising. This pattern of success is nothing new. But what does concern me more is a worrying trend that with our property markets now booming in some parts of Australia, some investors are so keen to do something, in fact so keen to do anything, that they're heading for property investment disaster. I've come across many potential investors who they feel they've missed out in the first 18 months or so of our property boom and they want to catch up. Others feel they're being priced out of the market and they're desperate to get a foothold in the rising property markets. Then there are those who find they're unable to get more finance and they're seeming willing to try almost anything to participate in the current property boom. To me, many of these potential investors are heading down the path of certain property losses. So today I'd like to share with you what I consider 3 surefire ways that some people are going to lose money in property and one way to ensure you invest successfully. What it boils down to is that in their bid to get into the property markets, many investors are starting to speculate rather than invest. The problem is they're determined to do something, so they don't want to miss out. Even if they don't have enough money, or they haven't developed the discipline to save, or they've already borrowed to their limits and the banks won't lend them more. Now, of course, I can understand why they're keen to share in the profits that others have achieved through property. But sometimes the right thing for an investor to do is nothing. I've made more money by things I have said no to than things I've said yes to. That's because all my investments have been made as part of a planned strategy that involves property, finance and tax. But many beginning investors are now making emotional decisions. And that's why I'm calling it speculating. Anyway, here are 3 surefire ways to lose money in our current property markets through, as I said, speculation. Now, the first one is buying off the plan. I know it sounds enticing, doesn't it? Buy today's price, then settle or on sell in a few years' time and you're going to make a profit. Sounds good, but does it work? Well, no, not in my opinion, and here's why. Firstly, the price of many off the plan property purchases are inflated by high marketing costs, promoters' margins, developers' profit, and the premium put on the price because it's the main type of property that many overseas investors can buy. You know, they can't buy established properties. Also, there's a looming oversupply of this type of property, these high-rise off-the-plan properties in many of our capital cities. And that's going to limit capital growth and rental growth. Of course, there's very little scarcity if you buy in a block of 100 or 200 apartments. That again limits your capital growth. And buying off the plan comes with uncertainties. Uncertainties about completion dates, the level of finishes, the market conditions when you eventually take place. And there's also a group of investors who actually are going to have to sell rather than settle. They can't get the finance, or maybe they never intended to settle on completion. They always wanted to flip the property when the building was completed. That means you're going to have a whole lot of apartments up for sale when the building's finished. And even if you're able to settle, the banks are only going to lend you a percentage for the new lower valuation of your property. So they're going to lend you based on the lowest sale price achieved by some of these desperate vendors rather than the price you contracted for. Add to this the fact that the banks often lend only 70% loan to value ratio in many of those big developments in those locations where they're situated. And what started off looking like a good investment turns sour. All this means is you need to buy off the plan properties at a significant discount to make up for these unknowns. But currently, developers have to sell their products to you at a premium, not a discount. They've got to do this to make the projects financially feasible for them. Now, if this isn't enough to turn you off buying off the plan, here's one last point. Almost all the projects, all those apartments in off-the-plan projects are being sold to investors. On the other hand, I like buying properties in buildings which have got a large proportion of owner-occupiers in them. I just find owner-occupiers tend to look after the buildings better and enhance their long-term capital growth. The second thing you should avoid is buying new homes in new estates. Look, I know some investors buy those homes in the new outer suburbs because they've heard that land appreciates in value and they feel they're getting a big block of land for their money. But when you think about it, usually the land accounts for maybe less than half the full selling price, giving these properties a very low land to asset ratio. Others are considering buying in these outer suburbs in the mistaken belief that properties out there are cheaper and they're therefore going to be more affordable to the masses as property values keep rising. Of course, this is wrong because that's exactly the type of area that's going to suffer the most when interest rates start rising. Residents in these areas tend to have less disposable income than people who live in the more affluent suburbs. They may be great places to live and bring up your family, but in general, new or outer suburbs are not good places to invest. Remember, one of the big factors that enhances capital growth is scarcity, and that's something that's missing in these suburbs. Many properties look the same, and there's always another estate or more similar houses or land just across the road there. Another reason I avoid investing in these areas is their demographics. They just don't attract the same demand from a diverse range of tenants that inner and middle ring suburbs do. Even worse, I'm now hearing a number of promoters who suggest trading new houses and lands. Buying a house, buying some land, building a house on it, and actually on-selling once construction's been completed. Boy, is this a recipe for disaster. Firstly, trading is not the way to become wealthy. Accumulating assets is. Secondly, there's no margin to allow for trading profits in this sort of property. Price-sensitive purchasers are just going to go down the road and buy from a builder who can always sell properties cheaper than a middleman can. And you know, even if you could sell, and you could sell for a higher price than all the other speculators, all the others who are trying to do the same thing as you, after stamp duty and tax, you'd lose out anyway. And don't be fooled into thinking these areas are going to outperform in the next few years. In the outer suburbs, people's wages tend to rise about the same as the CPI. However, in the inner, more affluent suburbs, residents have a greater disposable income, and their income tends to increase substantially more than the CPI. They've often got businesses or shares or other investments, and they won't be as worried by rising interest rates. Now, the third surefire way to lose money in property is trying to buy property with options. See, over the years, I've seen people come up with some creative schemes, and they're currently being again promoted by property spookers. People with little or no money are being tempted by the prospect of bypassing the step of developing the discipline of saving. They're happy to hear the promoter's suggestion that they could control millions of dollars worth of property using none of their own money. Now, there's nothing new about these schemes, but if history repeats itself, the promoters of today are going to become very rich, while their students will learn a very expensive lesson. Well, if these methods don't work, what does? There's one proven, time-tested method that made average Australians very wealthy. However, it's nowhere near as sexy as some of the smoke and mirror techniques I've just mentioned. If you want to grow your own significant property portfolio, you need to own properties that provide wealth-producing rates of return. This means buying a property below its intrinsic value, in a location that outperforms the averages with regard to capital growth, and a property to which you can add some value through renovations, or you can manufacture some capital growth through refurbishments or redevelopment. Now, that's what many of those investors who made it into these new ranks of Australian multimillionaires did. And you could also learn how to grow your wealth the same way as these sophisticated investors do, rather than looking back and regretting the decisions you're going to make in 2014. You see, in this cycle, just as in the past, while some property investors will do very, very well, many won't. To make sure you learn the lessons of the past to help secure your future, I'm going to be sharing exactly what I'll be doing together with a group of leading property experts at my National Property Market and Economic Market Updates. They're one-day trainings in 5 capital cities around Australia in March and April. Just click on the link on this page to find out more and reserve your seat, and I really look forward to seeing you there.